Having a bank account is the first step towards good money management, and by using your bank account to store your income, it is a lot easier to maximise your earnings. But what is your income? Income is a term applied to all money that you receive, be it in the form of your work salary, benefits from the Department of Work and Pensions, a loan, bank interest, or even loose change that you might otherwise throw away. Your work salary or weekly benefits is likely to be your main source of income and is what you live on from day to day. Weekly benefits for being unemployed is about £50 or £60 a week, which may sound like a lot, but you will earn much more money from having a job. After all, £50 a week works out at only £7 per day, but you would earn the same amount from working for only 10 hours a week at minimum wage. And if you were to work part-time, let's say 25 hours a week, then you'd earn about £150 every week, which is a much more enjoyable income than a puny £50 a week. And once you've secured yourself a job, you'll be much better placed to either find a new job or stay within your original job and gain promotions to earn even more money. Depending on your circumstances, you may have taken out a loan to supplement your salary, perhaps to help pay off a high interest debt or to pay for a new flat. Although some people might see a loan as free money, it is anything but that. Yes, for a short period of time you might get a large sum of money that you would not otherwise own, but there is a time frame within which you must repay all that money, along with some interest on top of that. Typical bank loans are likely to have a high interest rate to repay, normally around 15%, which is larger than the interest you receive from your savings account, 5% if you're lucky. Therefore, even if you take out a loan and plan to just save the money in your savings account, you are guaranteed to lose about 10% of your money on it. So unless you have a good regular income and can afford to repay that level of interest, taking out a loan is not recommended. Interest was covered when we were learning about banks and bank accounts, but just to clarify it again, interest is a small amount of money that banks pay you at the end of each financial year to reward you for saving with them. It is usually calculated as a small percentage of your savings, but the actual percentage rate tends to change throughout the year. Prior to the credit crunch and global recession in 2008, a good rate of interest on your savings would have been about 6%, but since the interest rate has plummeted to less than 1%, which means you cannot count on your interest to pay any decent reward at the present time. For instance, a savings account containing £1,000 in 2007 would have earned you around £70 from the interest, when based at 7%. But in 2010, a savings account containing £1,000 would earn less than 10, but still, that is better than nothing. Loose change, when collected over time, can also earn you a surprisingly large amount if you save it rather than waste it. For example, those 5p and 10p coins you keep getting as change at lunchtime will add up to a full pound within 2 weeks, or about £26 over the course of a year. Would you not feel happier with your finances if you are paying all that loose change into your account and watching your money grow, rather than wasting it on magazines and sweets?